Hey everyone, Mark Anderson here, construction worker turned 0DT hedge fund manager. And today we're going to break down something that most traders overlook. When building a portfolio, the relationship between beta, correlation, and alpha. For those of you that are new here, I run a 0DT hedge fund that has sold over $50 million in 0DT premium. If you've ever wondered why your trades feel strong individually, but your portfolio still takes massive hits, this video is for you. Let's first start with beta. Think of the S&P 500 as the foundation of your portfolio. Beta tells you how much of stock moves relative to its overall market. If a stock has a beta of 1, it moves exactly as the market. A beta of 2 is twice the volatility. Bigger gains, but bigger losses and more volatility drag. So it's actually worse than the market. A beta of 0.5 means it moves half as much as the market. For example, Tesla has a beta of about 2.7, meaning if the market goes up 1%, Tesla could jump nearly 3%. But if the market crashes 10%, well, you get the idea. So, beta tells us how much we zig when the market zags. If you hold Procter & Gamble, which sells toothpaste and soap, people are always buying these products, no matter what the market does. The stock has a lower beta. If you hold Tesla, it's a high risk, high reward situation. So the key question is, how much volatility can you actually handle? Now, let's talk about correlation. If beta tells us how much a stock moves, correlation tells us how different investments move relative to one another. A correlation of 1 is 2 dancers moving perfectly in sync. A correlation of 0 is like 2 dancers moving randomly, totally independent of one another. A negative correlation of -1 is 1 dancer stepping forward while the other one steps back. Why does this matter? Because if all of our trades move the same way, your portfolio is 1 market crash away from disaster. This is what I see that is common in portfolio theory that people get wrong. There is no such thing as uncorrelated. It's just a degree of correlation or inverse correlation. It's all a spectrum. Uncorrelated investments can cluster, and often at the worst times when you need that uncorrelation or inverse correlation the most. In my early days, I thought I just need a few high alpha trades. Wrong. I was placing different trades, but they were all highly correlated. So when the market tanked, everything dropped all at once. If your portfolio is built that way, you're just amplifying your risk. I call this diversifying for the sake of diversifying. This is an illusion, and you're adding more of the same type of trades to your portfolio. So if the S&P 500 is your foundation, then correlation is like the support beams to your portfolio. If all of the support beams are lumped together in one place, then the house won't stand. So you want to have correlated trades in your portfolio so that if one trading strategy takes a hit, the other ones can still stand tall and support the rest of your portfolio. What we actually want is a mix of trades where some zig while others zags. This smooths out your returns and reduces your risk over time. All right, now let's talk about alpha. This is the holy grail, the return that you generate above what the market would normally do for the same risk. You can think of alpha like the roof to your house, stretching upwards and pointing to the sky. If your portfolio grows 10% while the market grows 5% with the same beta, you have 5% alpha. If your portfolio grows 5% while the market is up 10%, you have negative alpha, meaning the roof collapse. But here's the kicker. High alpha doesn't mean high correlation or high beta. Some of the best traders aren't the flashy ones. They're the ones that keep the portfolio balanced. All 3 of these components, beta, correlation, and alpha, play into one another. If you add a trade that keeps your return the same and lowers your beta, that increases your alpha. If you add a trade that decreases your correlation by more than it raises your beta, that creates more alpha. So how do we put this all together? 1, manage your beta. Know how much risk you can stomach. Always target a beta below 1. I prefer 0.5 as a max. 2, diversify correlation. Don't stack trades that all move in the same way. The biggest benefit of diversification comes from 1 to 2 trades and 2 to 4 trades. By including inversely correlated trades, it can drastically reduce the correlation of your portfolio and buffer drawdowns, even if those trades only break even over time. 3. Optimize for alpha. Focus on consistent smart trades, not just home runs. A lot of your alpha is generated by losing less on the worst market days and making more on the best. At the end of the day, trading isn't just about picking stocks or trading one strategy. It's about building a portfolio that lasts. Construct a portfolio with a beta of 0.5 or less, diversify your correlations with at least 4 to 6 trades, and aim for smart, sustainable alpha with solid data inclusive of all market days. Drop a question in the comments below about portfolio strategy and let's discuss. On this channel, I cover everything from optimizing your trades to managing risk like a pro. If that sounds valuable, be sure to like, subscribe, and connect with me for more insights. Thanks everyone for watching, and I'll see you guys on the next one.